Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Good morning, everybody, and welcome to the September edition of the FX Monthly webinar. And it's been a busy summer, much busier than most summers normally in terms of the amount of market activity that we've seen, but also had some fairly sizable events taking place over the course of that period as well, which we'll try and summarise as best we can over the course of the next half an hour or so, and give us plenty of time for the Q&A session at the end. But without further ado, I'm going to plough straight into my presentation on the fundamental outlook. So the first slide is the content slide that will just look at what I'm going to take a look at. I'm going to do things slightly differently to how I normally do. In terms of I'm going to take a look at disposable incomes, and this is particularly UK disposable incomes, before then delving into the detail of what we expect to see from inflation, what the markets are now pricing for in terms of interest rates, and also other areas with regard to things like risk appetite and our forecasts on currencies. But let's go. Let's have a look at that next slide on disposable incomes. Now this is ONS data for disposable incomes, and also then a forecast, a worst case scenario, something that's been talked about in the media lately and by a number of economic commentators about how big the dip in household disposable incomes could be. And so you can see that the forecast is for disposable incomes potentially to drop back to levels that we last saw around 2003, 2004. And that's something that ought to be very alarming to the authorities, both the fiscal and monetary authorities, but it also ought to be alarming to a lot of businesses in terms of what this will do as far as discretionary spending is concerned. And I think that all economies, whether this is the UK, the US or Euroland economies, are going to face the same sort of challenges because of the increase in energy costs and food bills, and because we are starting to see the hangover of a lot of the financial support that we had throughout the whole of the COVID period. And moreover, I think that this won't be materially improved by the strength that we're seeing in the UK labour markets currently, because that is very much a hangover of the sort of post-COVID recovery period. The post-COVID recovery that we saw was very much about getting things back to where they were, which is where we are now, rather than getting things back to where they ought to have been had we not had the COVID pandemic. So you're still actually seeing economic output levels and the rates of employment within the UK economy and within other economies still below where we would have anticipated them to be had it not been for COVID. And moreover, that slump in disposable incomes is starting to manifest itself in terms of those big ticket spending items. So we're seeing housing demand falling off in a number of economies. We're also seeing the British Retail Consortium actually today reported that the retail sales growth was being masked by the increase in pricing, but actually there's been a slump in volumes, such that like-for-like sales are only up about 0.6% on a year earlier, and that's on a values basis. So if you were to include the increase in prices that we've seen across a broad swathe of retail sectors, then you're talking about a multiple percentage point drop in volumes. So if we move on now to the inflation outlook on this next slide, well, that's gotten worse for most of the major economies. So UK inflation on a CPI basis rose above 10% in July, prompted by further increases in energy and food prices, and there are more increases in energy and food prices to come, although we'll have to see whether Liz Truss works her magic now that she's now Prime Minister, see what rabbit she's able to pull out of any prospective hats on energy prices. We have seen a dip in US inflation rates in July from 9.1% to 8.5%. I think we ought to be wary of reading too much into that. I think there are still there's still a significant risk of much higher rates of US headline inflation. And I think that materially, the thing to focus on is the fact that their core inflation rate is well above the 2% level that the Federal Reserve is targeting. So there is still an inflation overshoot, even if you were to remove the effects of higher energy and fuel prices and higher food prices, there'd still be a sizable overshoot as far as US inflation is concerned. And then if we look at Euroland inflation, well, that exceeded 9% in the early August estimate. And that's given the European Central Bank a bit more of a headache as far as what they do on monetary policy. Markets are actually pricing for them to raise interest rates by 75 basis points, but it's whether that will actually have materially positive impact in terms of reducing the inflation rates that are being experienced in Euroland. And I would question whether or not that's the case. I don't certainly see there being an argument for much more aggressive tightening from the major central banks, given that, as I've said repeatedly in these calls, that they're not in control of the inflation that's being created. It's being driven by a twofold effect. Number one is clearly the rise in energy prices, which is leading to a significant increase in the cost of production throughout the economies. The second is the hangover from COVID, which means that from a short-term employment perspective, there's a lot more absenteeism because of COVID than one would have expected through the summer months. And that's only going to build into the autumn and winter as we see other respiratory diseases and viruses coming back to the forefront. So I do think that inflation rates are going to hold at very high levels. When they do fall back, it will be predominantly because of a collapse in energy price inflation and also a drop back in food price inflation as well. But that probably won't come until the second half of 2023. So moving on to the next slide and looking at how market interest rate expectations have changed. I mean, I actually look back to the beginning of the summer and interest rate expectations for the UK have increased by around 2 full percentage points. It's bananas, if I'm being quite blunt, because the UK economy is in no fit state to withstand that sort of rate increase. But that's more a function of the rout that's occurred in UK gilt markets rather than it is the expectation that the Bank of England can raise and sustain high interest rates in an environment where economic activity appears to be collapsing. And similarly, in Europe, there's been a big increase in interest rate expectations there as well. So around about 1 full percentage point on European interest rate expectations. Again, I'm not convinced that that's a sustainable position when there's been a marked deterioration in the economic outlook for the Euroland economy. It is noticeable that the rise that we've seen in US inflation has been, in US interest rate expectations has been less severe. So the markets are pricing in far fewer additional rate increases in the US than they are in the UK and in Euroland. And that's one of the reasons why we've seen forward points in the currency markets move materially worse in sterling dollar terms, so that now I think around about 13 months out, sterling dollar forward points are actually negative when they were considerably positive previously. And additionally, you've seen a notable narrowing in forward points as far as euro dollar is concerned. So if we move on to the next slide, these are the equity markets and what's been taking place here. And it's very difficult to identify that a potential dip in risk appetite is underway. But what I would say is just take a look at what happened in the post-COVID recovery. That big rally that we saw in the likes of the DAX and the Dow Jones and less so in the FTSE 100 and the CAC 40. and now look at what's happening, which is in effect a stagnation. And for a lot of these indices, a stagnation at levels where they failed to re-achieve their previous highs, particularly for the FTSE and the CAC Caron. This threat of increasing yields as far as bond markets, government bond markets are concerned, I think makes equity markets' job a lot harder. We're also seeing a lot more profit warnings, and we're seeing an increasing frequency of bankruptcies, insolvencies, and financial difficulties. And there was a report by an accountancy firm that talked about manufacturing insolvencies rising by more than 60% over the course of the most recent quarter compared with the same quarter a year ago. And they actually stated that their numbers were probably understating the scale of the manufacturing problem, in that there were probably a lot of voluntary winding up of businesses that went unreported versus the bankruptcies and insolvencies. So a real problem here for risk appetite, and one that may well manifest itself with much lower rates of equity valuation as we go through the remainder of this year and into 2023. Moving on to the next slide. One of the things I wanted to highlight here is we've been producing over the course of recent weeks a paper on the risks to sterling dollar, where we're talking about the risks of sterling dollar falling to and potentially below parity. It's been a very sharp and sizable move lower as far as sterling dollar is concerned, but there is potentially more to come. I still believe that the UK is uniquely disadvantaged with regard to the impact of inflation on consumer spending, and with the Bank of England seemingly more aggressive on their monetary policy tightening projections, then that could just be a double problem for sterling against the US dollar. We are no longer at a position where sterling dollar is going to be supported by the prospect of higher interest rates. And I think back to 1992 and the ERM crisis, where higher interest rates gave the pound no benefit against either the US dollar or the Deutschmark during that period. And I think we're in for an equally rough ride for sterling against the dollar this time around. Notably as well, the euro dollar has been below 99.99, and I think there's more risk of downside to come here. So moving on to the next and final slide that I have, that forecasts are under review should be in much bolder and brighter typeface. Don't look at these forecasts at the moment. We are looking at reviewing them. I think the risks are for a significant further downside to sterling dollar and euro dollar over the course of the next 3 to 4 months running into the end of the year and the early part of 2023. I think the other thing to watch out for again is things like dollar yen, which has recently broken through 141.5. I think that could be heading up towards 145 or even 150, and the Chinese renminbi, where we're repeatedly testing through 690 now. I think there's the potential for that to push on beyond 7 and potentially up towards sort of 720. So just watch out for those sorts of things. Emerging markets as well. If the central banks of the UK, Europe and the US do keep raising interest rates, and I think the emerging market currencies, things like the South African rand, the Brazilian real, and a whole host of emerging market Asian currencies could be under pressure because they've got higher interest rates at the moment, but any closing in the interest rate differential would be a potential negative for those currencies, alongside the negativity of the drop in risk appetite. So it's not great news. We've also got Italian elections coming up towards the end of September, which could create a further downdraft as far as euro dollar is concerned. I think we are in for a very prolonged period of economic turmoil and financial market turmoil, and as customers and as clients, we'll try and work with you as best as we can to make sure that you are at least impacted by that financial market turmoil that we can ensure. But on that note, I'm going to hand over to Piers. Piers, you can look at this from a technical perspective and perhaps give a slightly different view as to how you see the financial markets and with a particular look at currency markets, but I know that you've got a bit of a look on a few key interest rate markets as well. So Piers, over to you.
Thank you very much, Neil. Fascinating stuff as ever. Yeah, so I'm going to look at markets slightly differently to the way Neil's looked at markets. I'm just going to look at the price action. So if we go to the first slide, please. So the first slide, we look at the dollar index. Now, this is something I've been focusing on all year, that it's been a very strong uptrend, dollar strength coming, and we've seen that again. So I said on the last monthly webinar, you might get a bit of a pullback, but it's within an uptrend. And while 104 holds, the risk is we go higher. I said resistance 107, 108. If we broke through that, then to look for a move up towards the 112 area as a target. And we're seeing that move now going up towards that 112 happen. So the next two resistance areas I have are sort of around that 112 area at 111 and 113. So in that area, you might just sort of get some sort of stall in this dollar move, but the uptrend is very much still intact. So I wouldn't fight the uptrend, and I'd expect pullbacks lower to find support, but maybe just see a bit of a slowdown as we reach to that 61.8% and 76.4% area. So if we now go to the next slide, we're going to see how does that translate into the actual currency markets. So on this chart, we have a euro dollar. And if we look at the chart here, we can see that prices actually broken lower, and we're through this 104, 108, which has been the support zone going back for a long time. If you look back at 2015, 2016, 2017, that all held the market each time it went down. We've now broken below that, and I see that area as the resistance. So if you get any rallies now in euro dollar, I'd expect them to sort of stall by the 104, 105 area, maybe at a push up towards 108.50 area. Now, I think that on the downside, we have some support at 0.97, and that was a target I gave in sort of December last year, that there was a risk we were going to 0.97. And below 0.97, we have all the way down to 0.90 as a potential target. But I would imagine around the 0.97 area, 0.97, 97.50, I'd expect some support just to come in around that area. So keep watching that and see if there's a bit of a rally off there. But longer term, if this dollar move continues and we see that move continue down, there is a risk long term of getting down to 0.925 area. But at the moment, I think we might be in a 0.97 and a bit of a rally back off that area. So if we then go to the next slide, I'm going to look here at sterling dollar. So back in June this year, I said any clear quarterly close below 124.60.90 would open the 113, 114 area as a target. Now, last month, I didn't think that was going to happen in the short term, because if you see on this chart, we have that black dashed line going across, which is 121.59, and that was the lowest monthly close we'd had. And we saw the other month a spike below that. It came back up to close above it. It held the 76.4%. So I thought there was going to be a bit of a rally off that, back up a bit higher than it went. So you got a bit of a rally, but I thought you might get to the 124 area. It didn't get that far, and it crashed down. So all credit to Neil, because Neil was saying he thought it would go straight away. And we see that last month it did collapse down. And we've got to that 113, 114 area. So that 113, 114 area is quite important from a chart point of view, because it is a target area. So you've had that move down. So actually now we should start to see some support arrive just from people taking profit on the moves down. Now, sometimes you overshoot that a bit. So maybe into the 112, but I'd imagine the 112, 114 tact as a bit of a steadier here and push the market back up. We'll give it some support. It's also month 9, if you look in this chart. So And that means you've had 9 consecutive down months. You're allowed one slight up month on the body, and we had that. But I think that's another suggestion that the market might be just a bit overdone, and it might be a time for just a bit of a relief rally. So if we go to the next slide now, I've tried to sort of limit it down, saying 112, I think, should be the sort of support area, and then rallies back up. I don't see rallies back up getting too high. I think the 121.50, 123.60 area should cap any of these rallies. It might not even get that far, so you just have to watch it as it happens. What we do know, though, is if you get a quarterly close below these areas, then it starts opening up the further risks that Neil was talking about. So if you've seen my charts before, on the long-term quarterly projections, we have a target down below parity. So, and that's been open for quite some time. So we've come down, 113 was the target before that. So that's on the quarterly chart, an area that could provide some support. And then down below that, and I'll cover this next quarter, where we see it could get down to below parity if you get a quarterly close below there. But let's look at that next month on the quarterly charts. At the moment, maybe some support, 112.14 area, bit of a rally, but not exceeding 121.5, 123.5. If it gets above 123.60, then something's changing. Right, so that's sterling dollar done, and we can now move to euro sterling on the next slide. Now, I know Neil always assures me people don't like me talking euro sterling. Majority want to talk sterling euro, but I have to look euro sterling because that's what's traded, but I will come on to sterling euro levels in a minute. So before I said the resistance was 86.50, 87.50 area. And last month I highlighted that the 83 figure, 83.25, was a real key area of support to watch. So 83.06 was the 38.2% extension swing, and you'll see it on that chart there. And I said, while above that 83 on a weekly or monthly close, there was a chance for a rally here, and that we needed a clear weekly close below 83 to open any further downsides. We've got that rally off the 83 area, and it's taken us right back up to that key sort of 86.50, 87.50 area. So this is going to be a really important time for euro sterling. So we've got the two levels marked out so clearly now that we know that the support and the buyers are located at 83, 83.25. They've come out exactly where they should. They've taken price back up to this band, and you can see that for the last few months, it's always been stalled by that band. So if you want euro sterling higher, you need to see it break that blue band and get above 87.50. And the 86.50, we'll see on the next slide, is a reason why it's stalling as well. So if we now look at the weekly chart on this slide, if you get my weekly charts, you'll have seen this quite often. For the last few weeks, we've really been commentating that you had this downtrend in euro sterling, you broke above it, you retest back down to it, it bounced perfectly off it, it's coming now back up. It's trying to see where can it go. An important factor last week was you had the highest weekly close for euro sterling. So there's a positive for it. It was the highest weekly close. But the negative for it is still that same sort of area. It's that 61.8% at 86.60 and the 76.4% at 87.37. So I'd expect it to back off this area, that area, the 86.60, 87.37, have a look back down, and then the real key will be the 86 area, as we said, on the monthly chart. But on this weekly chart, you could maybe see it go down towards 85, 30, 60. Now, if it can hold that and bounce off there, then the upside risk still looks open. This looks like a break and retest higher. If it starts to get below 85, 30, 60, then this move higher is starting to lose its force. So if we go to the next slide now, I'm going to look at this now on a sterling euro basis. So on this one, we were looking before at the support, those two dashed blue lines at 114.30 and 115.60. That produced a rally, and that went back up to the 120.10.40 area we were talking about. It then has crashed off that area and come back down to test that 114.30, 115.60 area. So again, we know the key areas to watch. It's a sideways battle. You can see that through 2021, it's just been going up off that 114.30, 115.60 area, up to the 120s, come back off. Now it's decision time. So it was such a negative month last month that I think that the pressure could be on for a test down into that 114.30, 115.60 area and a break below that. But we have to watch how it plays out. And we can do that on a quicker way by looking at the next slide, the weekly charts. And I will keep this posted every week. I'm sending this chart out, watching what's happening. So we're watching at these extensions off the break of the trend line there that you see where those arrows are. I highlight the break, the retest up to it, then the fall off it. Again, look where that 61.8% is. It's this same area. So if you do get those weekly charts, it bounced really nicely last week off the orange dashed line we had on there. It held the 61.8%. It's that 61.8% to 76.4% on this chart. You really need to keep an eye on that. So while price remains below 116.85, 117.25 on a weekly close basis, then the risk could be it's maybe going down to 114, 113 area. But let's see how it plays out. We know the key levels to watch. Keep watching those levels. You'll get sent these slides. I've written them on the slides. You'll get some commentary. And those are the levels to watch on euro sterling and sterling euro. So as Neil said, one thing we said we'd do this month was look at some of the interest rates. Now, interest rates, what tends to get traded more, and Neil alluded it to there when he was talking about the UK rates, was the gilts and the US Treasury. So I've put the gilt market on the next slide. And this is the long-term gilt market going from 1990, 1988 area. But from 1990, you can see there was a nice trend line going up. So UK gilts were on a steady progression higher and higher. It then topped out. And then over the course of 2020, you can see it drop down. It broke that trend line up from 1990. Last month, it went up to the 23.6%, failed there, and it fell. Where's it fallen to? It's fallen to the 38.2%. No difference in these rules to any of the other currency charts or any other market. They follow the same rules. So that makes me think that maybe here in the 105, 107 area, you might start to find some support on UK gilts. It might overshoot a bit. It might go down to that 101.98 area. But I would expect some sort of bounce here off the 105, 107 area. But it does look like a break of a trend line. So on technical analysis, I'd expect the rally off this 38.2, if there is a rally off 38.2, to start to struggle as it gets higher, back up towards that 119. And then I think you'll see it come back down. And I think at some stage you could see 97.101 being tested here. And then that's UK rates, what's sort of looking the situation here. And on the next side, we look at US rates. And here I've taken the 10-year Treasury notes. Again, the same sort of thing. Look, from the 90s, there was a nice trend line going up. It bounced every time it hit that trend line. What's happened since 2020? The market has just collapsed down. So what's interesting here is that when it broke the trend line, it also broke the 38.2% area. So in that little ringed area, and don't worry if you can't see it so well on this presentation because you will be sent the slides and you'll see it. The market retests back up to that and it's fallen off it. Now that is also the 38.2% there. So at the moment, I see that as a sort of resistance area, 120, 121, and that should hold the US 10-year Treasury. And then I feel that the risk is we could see it come even lower and maybe get down to the 108. Where would that view change? If you got above the 120, 121 area, then you'd have to sort of back off that view and say maybe rates are going to go, the Treasury notes rate is going to go a bit higher. But I hope that helps just on what I think on gilts and US 10-year Treasuries. They are the inverse of the interest rates, but they're better traded. And that concludes my part today. So there's the important information. I love the way they put important information on that. Maybe it means all the other stuff I've said isn't important information, but we'll see how that goes.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.